Welcome back to Talk Tickers, the show where we strip the corporate veneer off the earnings call and get straight to the raw mechanics of the business.
It's good to be back.
Today, we are heading down to the oil patch. We're looking at a bank that's trying to pull off a very difficult maneuver.
A metamorphosis, really.
Yeah, exactly. Yeah. Transforming from a sleepy West Texas operator into a high-growth Houston powerhouse. We are breaking down the Q4 2025 earnings for South Plains Financial, ticker SPFI.
And you frame that perfectly. This isn't just about one quarter. It's a check-in on this huge strategic pivot.
Right.
You have a bank based in Lubbock, deep in the Permian Basin, trying to deploy all this excess capital to go conquer the Houston market.
The market seems unconvinced, or at least hesitant.
It's a show-me reaction, for sure.
So to set the scene for everyone, today is January 27, 2026. The earnings dropped late yesterday. And looking at the session today, the stock finished down about, almost a full percent.
Yeah. 0.92%. It's not a crash, but it's definitely not a victory lap. Investors are looking at the revenue line and saying, the math looks a little messy right now.
Okay, let's get into that messiness. We have to start with the headline numbers because they tell a pretty conflicting story.
They really do.
On the bottom line, profitability looks great. They delivered GAAP earnings per share of 90 cents.
And the street was at, 84?
84 cents, so a solid 6-cent beat. Usually a beat like that gets you a green arrow the next day.
Usually. But then you look at the top line.
Right. Revenue came in at $53.88 million, just missing the consensus of $54.11 million.
So more profit than expected, but less money coming in the door to generate it. It's a weird look.
And just to round it out, tangible book value rose to $29.05. That's up 14% year over year.
And that TBV number, that's your floor. I mean, if you're a value investor, seeing that up 13% is your safety blanket.
But let's go back to that disconnect, the EPS beat versus the stock price drop. Why the punishment for a small revenue miss?
It's all about timing. It's one of those tricky things about banking and the calendar.
So I was looking at the loan data, and it looked like they grew the book. If loans are up, shouldn't revenue be up?
You'd think so. But management explained that while the end-of-period loans were up, the average loan balance for the quarter was actually down a bit.
How does that happen?
It's like, imagine you hire a whole new sales team on December 20th. You pay their signing bonuses, you book all those expenses in Q4.
Okay, so the costs are in.
The costs are in, but they don't actually close their first deal until January. So Q4 carries all the weight of the costs, but gets none of the revenue.
So SPFI had a surge of loan growth, but it funded very late in December.
Super late. So they have the loans on the books now, but those loans didn't really generate interest income for most of the quarter.
So the algorithm trading bots just see revenue miss and sell.
Exactly. They see the headline and dump it. But a human analyst should see a loaded spring ready to pop in Q1.
Well, that puts a lot of pressure on Q1 then.
A ton. If that revenue doesn't show up big time in April, then it wasn't a timing issue. It was a growth issue.
Speaking of growth, let's pivot to the biggest story here. The acquisition of BOH Holdings, the parent company of Bank of Houston.
This is the whole thesis for the next 3 years.
Let's run through the specs. It adds $633 million in loans and $629 million in deposits.
Which gets them to over $1 billion in loans just in the Houston region alone. It's a huge move.
And is projected to close early Q2 of this year, 2026.
And this is where we have to talk about accretion. It's one of those banker words.
Yeah, break that down for us. What does that mean in plain English?
Okay, so management is guiding for roughly 11% EPS accretion in 2027. All that means is that by buying Bank of Houston, the earnings per share for SPFI shareholders will be 11% higher in 2027 than if they hadn't bought it.
11% is a big number. Is that realistic?
It's aggressive. It assumes a smooth integration. They also mention a tangible book value earn back of under 3 years.
And that's the break-even point on the deal.
Pretty much. Anything under 3 years in banking M&A is considered a home run.
But I have to play devil's advocate. I get the theory, take cheap West Texas oil money and lend it out in booming Houston.
The geographic arbitrage.
Right. But isn't that just a polite way of saying they ran out of growth ideas in their home market?
I mean, that is the cynical take, and you're not entirely wrong. Lubbock is a fantastic market for stable, cheap deposits.
But it's not a growth engine.
Not at all. If they stay in Lubbock, they're a nice, safe, dividend-paying utility that slowly becomes irrelevant. This is a survival pivot. It's eat or be eaten.
And Harris County is the fastest growing county in the U.S.
Exactly. They're buying a future that just doesn't exist in the Permian Basin. But there's another layer to this that I think the market is missing.
Which is?
The funding synergy. Bank of Houston is a great lender, but their cost of funds is high. They don't have that deep, cheap deposit base that South Plains has.
Because South Plains has all those legacy relationships in West Texas.
Right. So SPFI can take their cheap money and fund Bank of Houston's expensive loans. It's instant margin expansion.
It's a classic buy a great lender, fix their funding costs strategy.
It is, and it doesn't sound like they're done. CEO Curtis Griffith dropped this little breadcrumb on the call.
I caught that. He said they have the capital capacity for another bank of similar size.
That was a flex. Usually you say your head's down on integration. He's basically putting an open for business sign on the front door.
Which is exciting, but let's look at the engine room, the margins. This is where the macro environment is starting to fight them.
The net interest margin, or NIM, the lifeblood.
They reported a NIM of 4.00% for Q4, which is up a lot year over year.
Up 33 basis points.
But if you strip out some one-time fees, it's basically flat quarter over quarter.
And this is the friction. Management says they expect to hold margins, but the math is getting so much harder in 2026.
Why is it getting harder? The Fed's cutting rates. Shouldn't that lower their costs?
You'd think so, but the danger here is something called deposit beta.
Okay, what does that mean for a savings account?
It measures how much your deposit rates move when the Fed moves. They said they're seeing a beta of 30 to 35%. Meaning for every 1% the Fed cuts rates, SPFI can only lower the interest they pay you by about 0.3%.
So they can't lower their costs very fast.
Right. But their loans, many of those are floating rate. When the Fed cuts by 1%, the income they earn on those loans drops by 1%, like instantly.
So the revenue takes the elevator down, but the expenses take the stairs.
That is the perfect analogy. And that lag creates margin compression.
And they mentioned competition's making it worse. If the big banks don't lower their CD rates, SPFI can't either, or they lose customers.
Exactly. That public funds money is hot. It'll move for 10 basis points. They have to fight to keep it.
Okay, I want to shift to a part of the call that felt a bit like a therapy session. The indirect auto portfolio.
Yeah. The defensive disclosure.
They spent so much time on it.
Yeah.
Why the upset?
Because investors are terrified of consumer credit cracking. Auto loans are the canary in the coal mine.
So let's look at the stats. The portfolio is about $241 million, and it's shrinking on purpose. 94% was originated as super prime or prime.
Which sounds great. We only lent to the best people.
But then they dropped the scary stat. $9.2 million of that has migrated to deep subprime since origination.
And this was the most fascinating part. Why did these prime borrowers fall off a cliff?
Wait.
Management did a forensic analysis. It wasn't student loans. It was missed credit card payments or small medical collections that just tanked their FICO scores.
So their credit scores imploded, which usually means default is coming.
Usually. But here's the nuance. In Texas, in this demographic, you might stop paying Visa. You might go to the hospital, but you never start paying for your truck.
Because no truck means new job.
Precisely. And the data backs that up. Despite that score migration, the delinquency rate 30-plus days past due is only 0.19%.
That's incredibly low.
It's basically nothing. It tells you the consumer's bending, they're prioritizing their mobility, but they aren't breaking on the car note.
So for the SPFI investor, the takeaway is the auto book isn't a time bomb.
Correct. I think they made their case pretty effectively there.
Let's zoom back out to operations. They're guiding for mid to high single-digit loan growth in 2026. How are they going to get there?
They're poaching talent. They call it the dislocation strategy.
I love that corporate euphemism.
It's a polite way of saying, your bank just got bought, you hate your new boss, come work for us.
And there's a lot of that going on in Texas right now.
A lot. So they're standing there with a checkbook, hiring these lenders away from bigger banks.
But that talent isn't free. And this brings us back to expenses. The CFO was pretty clear. Expect a hike in Q1.
Yep. This connects back to that timing mismatch. You hire an expensive lender, you pay them a big salary on day one. It's the J curve.
The J curve.
Things go down before they go up. You spend the money now, that's the dip in the J, but that lender doesn't start bringing in meaningful revenue for maybe 6 months.
So Q1 and Q2 could look rough. Margin compression from the Fed cuts, plus expense inflation from the hiring spree.
It does, and that explains why the stock is stuck. Investors see this gap between now and the BOH accretion kicking in 2027.
So let's answer that. Why is the stock just a market performer?
Yeah.
Over the last year, it's basically tracked the KRE, the regional banking ETF.
The verdict is that the market is discounting the M&A. That 11% accretion in 2027 is a believe it when we see it metric.
Because bank integrations are messy.
Notoriously messy. The market is pricing in a lot of execution risk.
So the trade-off is you get a solid dividend, but you have to wait 18 months for the Houston deal to really juice the EPS.
That's the hold. And if you're holding, you need a catalyst. The catalyst to watch is the Q1 net interest income.
Because of those loans that funded late in December.
Right. Q1 needs to show a massive jump in interest income. If it doesn't,
then the growth story is broken.
Exactly. If we get to April and revenue is flat again, the market will punish them. They have no excuses for Q1.
Okay, so we have this really interesting setup. A bank with short-term stress, but long-term ambition.
Big ambition.
And this brings us to the part of the show where we say, this is absolutely not financial advice. This is for entertainment purposes only. Do not do this, but purely as a thought experiment.
Yeah.
What's the trade?
The trade is to front-run Curtis Griffith's ambition. I call it the Texas Triangle Squeeze.
Okay, lay it out for me.
Step 1, you go long SPFI. You are betting on the predator. They have the capital, they have the stock, they have the ego to grow.
So you own the acquirer.
Step 2, you hedge your sector risk. You short KRE, the regional bank ETF.
Why?
Because the index is full of banks suffering from that margin compression we talked about, but they don't have that M&A growth story. So if the whole sector tanks, your short protects you. You isolate the SPFI alpha.
Clever. But I know there's a step 3.
Always a step 3. Simultaneously, you buy deep out-of-the-money calls on small, publicly traded, Houston-based banks.
You're literally front-running their M&A department.
That's the game. You're betting SPFI becomes the aggressive consolidator of the Texas Triangle. If they hit that 11% accretion and then announce deal number 2 by late 2026.
Let me guess. SPFI stock goes up because the model works.
Right, ripping the face off anyone short. But the real juice is in the calls on the target. Those options go from pennies to dollars overnight.
So you're playing the empire building premium before the market prices it in.
It's a bet on ambition. In regional banking, it's eat or be eaten. SPFI has decided to eat. You just want to own the menu.
Fascinating.
Yeah.
And incredibly risky. Again, listener, please do not do this.
Please don't. Just buy the index and go for a walk.
All right, bringing it back to reality to close this out. It was a mixed bag from SPFI. A solid EPS beat, a revenue miss that has an explanation.
An explanation that needs to prove itself next quarter.
Right. And the auto portfolio seems to be bending but not breaking.
And that Bank of Houston acquisition is the entire story to watch. If they integrate that well, this is a completely different bank in 2 years.
Final thought. What's the one thing to watch on the terminal?
Watch the deposit betas. It sounds boring, but it's the whole ballgame. If they can't drop their deposit costs as fast as the Fed cuts rates, then that 4% IM is the peak.
Yeah, 4% is the peak.
The stock is fairly valued right here. If they can push margins higher through the BOH deal, it's cheap. It all comes down to the cost of funds.
It always does. Thanks for listening to Talk Chickers. We'll catch you on the next print.